Good morning, everyone. This is Kathy. Hello, hello. I want to wish you all a great morning here in New York. It's a beautiful day. Let me know that you can see my heat map and you can hear me in the YouTube live stream or in the Ask Kathy room if you are a BK member. Let me know that my sound and my visual is coming through. I can see it through the YouTube live stream, so it should be okay on my end. Let me know that everything is working, my friends. Say yes, say no, no one's answering me, so I'm not sure if it's working. If you can see me, if you can hear me, let me know, please. I'm gonna ask, can you see and hear me? Everything seems to be okay on my end. Thank you so much, Jeff. Thank you so much, Dean. Wonderful. Okay, and Chi. Good morning, everyone. Welcome to Kathy's Caffeinated Market Buzz. We have so much to talk about today. But first, let me know where you're dialing in from. I hope some of you had joined our live trading session on Friday with non-farm payrolls. That was a really fun day. We made a lot of pips, but I think, you know, it's more important to, and a lot of the reasons why we made money is because we had a trading plan and we were prepared for what is to come. And that is why the Monday Market Buzz is so valuable, because there's so much to talk about and so much to prepare for, especially on a week like this one, where we have a tremendous amount of event risk. Hello, Jeff from Portland. Thank you so much, Za. I got a haircut over the weekend, right? Yeah, ready for summer and, you know, ready for the nice warm weather. Hello from Germany. A lot going on in Europe today, which we will be talking about. The biggest mover today is hands down the euro, which has fallen to a 1-month low. And while many of you may know what the story is about, you may not be you may not know what the implications of the European elections results are for those countries and Europe as a whole. And that is exactly what we are going to be talking about today. And of course, we're going to talk about the Federal Reserve meeting, the inflation report, the Bank of Japan meeting, what is expected for all of those, how to trade them, along with what else is expected on the economic calendar. So yes, you're asking me a question about whether I'm bearish, bullish or bearish euros after the rate decision. We'll talk about that, but I personally am much more excited to talk about the election in Europe and what it all means. So thank you so much. Thank you for complimenting me on my new hairdo. I appreciate it. Okay, so let's get started. You're looking at my heat map, and there's the market's focus remains on the US dollar this week. That may not appear so today with the US dollar mixed and the euro falling to a 1-month low, which we will talk about. But the main event risk on this week's calendar, US inflation and the Federal Reserve meeting makes the dollar in focus. Now, obviously, we're coming off a backdrop of stronger non-farm payrolls. And believe it or not, and we talk about this, we've been talking about this week after week, rate cut expectations have changed dramatically. The market has gone from 4 interest rate cuts at the beginning of the year to now just fully pricing in 1 by December. Now, there's still about a 50% chance of 2 interest rate cuts this year, but the market's really just pricing in 1, which is dramatic. And the question this week is, whether that's true. Who's on board with this decision? So right now, we're still bullish dollars because for the most part, data from the US has been good. And for the most part, there's no reason to believe that the Federal Reserve is going to lower interest rates. But that does not mean that this is not going to be an important rate decision. This will be an important rate decision because we have the dot plot being released. Whenever the Federal Reserve dot plot is released, it's very important because it's only released quarterly. We had it in March, and now we have it in June. And what the dot plot, the Federal Reserve dot plot shows us is what the market is, what the Federal Reserve officials think in terms of the number of interest rate cuts that they think, these are the people who, cast the vote, the US economy needs. And in March, the Federal Reserve, the dot plot showed 3 interest rate cuts for 2024. You and I both know it's not what everyone feels like. It's not what the majority, if not all, of the Federal Reserve presidents think will happen this year. So for sure, the dot plot is going to shift in favor of less interest rate cuts. The question is, will the dot plot move down to favor 2 or 1? Will be really close. Obviously, if the majority of them expect only 1, that's going to be very, very good for the US dollar and very, very bad for US stocks because 1 interest rate cut is dramatically different from what everyone anticipated at the beginning of the year. So 1 interest rate cut would mean that, rates remain high, which is bad for companies, bad for stock, bad for future growth, good for the dollar. But it's more likely that it will be closer to 2 or 2. And that's where it gets a little tricky. 2 is still more bearish for stocks and bullish for the dollar than 3. So it would have gone from 3 to 2. I think there's a very, very low chance it's going to stay at 3. If it stays at 3, it would be very negative for the US dollar and very positive for stocks. Because it would say that even with all of this good labor market numbers and all these other reports, most Federal Reserve officials still think 3 interest rate cuts are necessary, which I don't think is going to happen. 2 is really the most likely scenario. So the question is, what's the market implication? What's the potential reaction? What's tradable if it's 2? Well, if the dot plot favors 2 interest rate cuts this year, I think initially we're probably going to get a rally in the US dollar because 2 is less than 3. But I don't think it's going, I think it's going to be short-lived. I think that because the Federal Reserve rate decision is separated into 2 parts. At 2 o'clock Eastern time, we have the rate decision. So, no rate change is a done deal. At 2 o'clock Eastern time, we also have the dot plot and the GDP forecast and the inflation forecast. And then at 2:30, we have the press conference 30 minutes later from Fed Chairman Powell. So Fed Chairman Powell speaks 30 minutes later. And the question here is, first of all, when the dot plot comes out, if we get 2 interest rate cuts favored by the dot plot, I think we'll see an initial dollar rally, initial pullback in stocks, but I think it's going to be short-lived. In terms of the GDP and inflation projections, that's also something everyone's looking at very closely. And I think they're going to raise their GDP forecast because a lot of the indicators, particularly on the labor market, have been better. And I think they're probably going to lower their inflation forecasts. And so that will probably end up being a little bit of a wash. But if that's the case, if they do lower the inflation forecast, that is actually going to confirm my view that any initial rally in the dollar, if the dot plot shifts in favor of 2 rate cuts, is going to be short-lived. And yes, Ryan, there's no way the Fed is lowering interest rates at this week's meeting. So then what we go to Fed Chairman Powell's press conference at 2:30. He's obviously the chairman of the Federal Reserve. So even if the dot plot and the economic projections are kind of wishy-washy and they provide no real clarity, everyone will be looking for guidance from the Fed chairman. And anything important he has to say, all of the important questions that are going to be asked will be done in the first 15 minutes. So we'll know by 2:45 New York time what the real reaction in the markets is. We'll know by then whether he agrees that 2 is needed or 1. Now, because the market is currently pricing in one interest rate cut. I kind of want to say 1.5. The market's pricing in 1.5 interest rate cuts. 1 would be very positive for the dollar and negative for stocks. If he suggests that maybe they don't need to be so aggressive. If he still says things are data dependent and we could still do 2, or suggest that this could act in the fall, which is sooner than December, that I think will end up being negative for the dollar and positive for stocks. But for now, I'm bullish dollars because I think that at the end of the day, we're not getting interest rate cut on Wednesday, and I think that the sentiment is going to be more bullish than bearish. However, take a look at this. This is my table of how the U.S. economy changed from one meeting to the other. We've been looking at these, and I put them together myself for the last couple of major rate decisions, including the European Central Bank rate decision. And with the European Central Bank rate decision, we'll talk about that in a second. We saw how it was a sea of green, where we had mostly improvements in the economy. And because we had mostly improvements in the economy, that justified a hawkish cut. This does not necessarily justify a hawkish hold. Now, retail sales were weaker, and retail sales on the consumer level have been very, very weak. Consumer sentiment numbers have been weaker as well. Labor market conditions is where we have the strength. Non-farm payrolls have been very, very good. The unemployment rate was weaker, but average hourly earnings is also stronger. And this allows the Federal Reserve to wait, because labor market conditions have been in a situation where it is not dire enough for the Federal Reserve to cut interest rates early. Inflationary measures, I have neutral. And the reason why I have inflation measures neutral is because, yes, inflationary pressures in the U.S. in the month of April are all dollar bearish. They have eased, but 3.4% is really, really high. 3.4% is much higher than the Federal Reserve's 2% comfort level. So this should actually be dollar bullish. So labor market conditions, inflation numbers are kind of dollar bullish. Housing market activity has weakened. Housing market index is lower. Existing home sales have improved, but they're still negative. Pending home sales dropped a lot in April. New home sales dropped as well. Housing market activity suffering. Manufacturing and services. Manufacturing activity is slowing. GDP growth slowed. But service sector activity, which is the backbone of the U.S. economy, actually accelerated. So that is good news. Trade data was weaker. And then the stock market is higher, but bond yields are already lower. So it's already doing the Federal Reserve's work for them. So taking a look at this, it is a bit of a tough call, but the ones that matter, the labor market, the inflation numbers, still justifies a wait and see mode by the Federal Reserve. But it also confirms that the economy is slowing, but not as dramatically as to a point where the Federal Reserve needs to be worried. So I am still dollar bullish. And I think even if the dollar sells off after the Federal Reserve rate decision, unless there's something really new revealed, I think that the buyers will continue to swoop in. And for those of you that are joining us late, I said that the dot plot from the Federal Reserve meeting is going to be the most important aspect of the FOMC rate decision that we're all going to be looking at. So euro, I'm neutral euros. I'm neutral euros because it's really a week for the US dollar. But the big story for Europe is obviously the election results. The far right, got a lot more power than than France and Belgium expected, And while Macron is going to hold on to power, there are some important implications. And the number one most important implication is protectionism. This means that they're going to be much more inward looking. They're going to be there's going to be much more resistance to being generous, I guess, which means less funding for Ukraine, maybe less fiscal stimulus, because the polarized parliament may make it difficult to pass any fiscal stimulus measures. There's going to be more moderate policy commitments, less willingness to allow for strategic industries, more intervention, more prevention of things to happen and grow, and then also maybe a tougher stance on China and a tougher stance on Chinese exports. None of that is business positive. And so none of that is positive for capitalism. And I think that's why euro is lower, because markets believe that this is going to be less positive for everyone in general. So euro selling off, and I think overall this is going to be much more negative for the euro. Last week, as we said previously, we had a hawkish cut by the ECB. Some of you are asking, what is the implication for this? And the implication for this is that, basically this hawkish cut is going to is basically positive for the euro. I mean, we're in a situation where we do see where we basically do see the ECB, not necessarily looking to lower interest rates again, even though they had just done so. So euro is going to trade on the market's appetite for US dollars, but because of these election results, I think that there's a very, very good chance that euro is going to remain under pressure, which is good for the dollar bullish view. It's consistent with the dollar bullish view. So that's what I'm thinking. That's what I think is going to happen. And that's why I'm neutral. I would have to say I'm neutral bearish euros. And not because of the ECB, not because of the ECB themselves, but because of the election as well as my dollar bullish views. Okay, so then we have sterling. We don't have any other real UK data this week, aside from, we don't have any real Eurozone data this week. The focus will be on the US dollar. And then we have the UK. We have the UK jobs report tomorrow. The UK jobs report is very, very important. The UK jobs report, especially the wage component, is going to play a very big role in deciding whether or not the Bank of England is going to need to lower interest rates soon. And that is something that is going to be very, very impactful for sterling in the week ahead and the week after. So we're all watching that very, very closely. It's a very important piece. And unfortunately, I think that UK wages are going to slow. And then we also have, so that's why I'm bearish sterling. As for Australia, I'm neutral. We have Australian jobs report this week. And for the most part, Aussie's been kind of outperforming. The Australian economy has been doing better than other countries. And overall, I would say that the market is definitely thinking that the RBA is not going to lower interest rates soon, but it depends. If the data continues to slow and we do see a more kind of dramatic slowdown in the labor market activity, then yes, we could be in a situation where Aussie could fall. But I think it would be remiss for any of us to think that Aussie or any other currency is going to move on anything but the market's appetite for US dollars. And for those of you that are joining us late, we talked a lot about the Federal Reserve and how the dot plot is the most important aspect of the Federal Reserve meeting. So make sure you tune into that. The Canadian dollar, I'm still bearish. We had weak jobs numbers, very weak job numbers. There's a good chance that they're going to lower interest rates again. There's a good chance that they're going to lower interest rates again as a result of the rate decision. So, that is something that, I think could happen. That is something that is going to keep the currency depressed. So definitely watch out for that, because it's a situation where CAD will probably outperform all of the other major currencies. Kiwi, I'm bullish just simply because data from Kiwi hasn't been that terrible. And for the most part, we are in a situation where New Zealand data has been better than data from other countries, but we do have New Zealand PMIs this week. Swiss data has also been better, so I'm bullish Swiss data. I think that is going to be supportive, and I think that's going to be good. And then the yen, we have a Bank of Japan rate decision this week. And the Bank of Japan rate decision is very important. The Bank of Japan is not expected to raise interest rates, but there could be talk, and there could be even the possibility that they taper bond purchases, which is effectively a way to raise interest rates. If they talk about that, if they talk about that, it's going to be less meaningful, because with the Japan market wants action, not talk. They talk about it, I think it's going to matter less. If they actually do it, I think we could see a rally in the Japanese yen. But ultimately, I think that Ueda doesn't really seem to be a proactive central banker. I think that he's going to take more, he's going to be a slow to move, and I think the outcome is going to be more yen bearish than bullish. So hopefully that answers your question, Ali. All right, so now taking a look, and earlier we did look at the Fed table that I normally put together for those that you missed out, and I talked about how the parts that matter, the inflation part and the non-farm payrolls report, still supports more of a hawkish hold. All right, so GDP numbers revisions from Japan, were pretty much in line with expectations. Unfortunately, the Eco Watcher survey was revised lower, and the downward revision to the Eco Watcher survey is negative is the reason why the yen is trading lower. We had holidays in Australia and China, and nothing in the US today. Swiss confidence was a little weaker. And then we have the Australian business confidence tonight, which will be important. We'll have to see how that fares. And then tomorrow, Tuesday, we have the UK labor market data. And even though employment change is expected to fall by less, first of all, it's still a drop, right? 100,000 is a lot of jobs lost. And average hourly earnings is what everyone's looking for. If that slows, and I think it will, it'll be very negative for sterling. And this is the most important piece of data for the UK this week. We have nothing going on for the US on Tuesday. We have PPI data from Japan, which could be a little hotter. Inflation data from China is quite important. And that is expected to show inflationary pressures stabilizing and deflationary forces subsiding, which if that is good for, that is higher and good for the Chinese yuan, it should be good for the Japanese yen. Revisions for German inflation data, not a market mover. UK also has 3-month GDP numbers. That's expected to be a little harder. But the focus on Wednesday will certainly be US inflation data. Now, normally US inflation data is very market moving, and it still will be. But whatever comes out, the market's is going to think, let's just see whether or not the Fed meeting confirms or denies it. Now, in terms of inflationary pressures, the market is expecting CPI growth to slow from 0.3 to 0.1 because oil and gas prices are lower. So they are expecting inflation in the US to be weaker. So that could be dollar negative, but they're going to think, look, 3.4% annualized CPI rate is still well above the central bank's 2% inflation forecast. So the Fed's not going to do anything, and the dot plot will probably still favor either 2 or 1 interest rate cuts this year. So I think that this significance is definitely undermined by the Federal Reserve meeting. And as I said at the top of our webinar, our live stream, that it's a two-pronged rate decision. First, you've got the interest rate decision, the economic projections at 2 o'clock. Then you've got the press conference at 2:30. And the dot plot is released at 2 o'clock. So that will be very market moving, even though the Fed is not expected to change interest rates. Don't expect this to be a non-event. Don't expect little volatility. Don't expect the market knows exactly what's going to happen because they are completely guessing on whether it's going to be 2 or 1 rate cut favored by the dot plot. And of course, the press conference will be very important. And then later that evening, we have New Zealand credit card spending, Australian consumer confidence, Australian jobs. Australian jobs are very important. And like Canada, the full-time, part-time component will be the most important. If we have full-time job growth, that'll be great. If we have full-time job losses, that's really bad for the Australian dollar. And then on Thursday, we have industrial production numbers from the Eurozone. The PPI is going to be a non-event after CPI, and same story with the jobless claims report. That's not going to matter at all. The CPI as well as the inflationary measures are going to be carries over for the rest of the week. Then we have New Zealand business confidence, which will be important. Unfortunately, I think that could actually slow. And then Australian inflation expectations, which should be a little weaker as well. And we end the week with some minor data from the Eurozone and the University of Michigan Consumer Sentiment Index for the month of June, which could be a little firmer given the non-farm payrolls report. All right, now let's look at our charts. So as I said earlier, Euro plunged after the election results, and we talked about why it's so important. The Euro plunged after the election results because basically it means more protectionism, more resistance to new measures, more conservative policies going forward. Don't know why my TradingView charts are not loading. I think here we go. They should load now. All right, so in terms of euro dollar, we're below all of the major moving averages. We're in a downtrend. I'm bearish euros. I'm neutral bearish euros. I'm bullish dollars. This is obviously the market's going to wait for FOMC and CPI, but I think that at least from a chart perspective, we could test these lows here at 107.25, which is not that far from here, and maybe even hit 107 figure. But I don't expect much more of a move beyond that, although euro against the crosses like euro Aussie, euro Kiwi should continue to move lower. Pound dollar is waiting for tomorrow's wage report. Right now it is bearish. If the wage report comes out lower, I think we can see a much more dramatic move lower in sterling down to 126.50, 126 even. If it closes back above the 20 SMA, which is at 127.25, we could have a chance of retargeting the prior highs. Dollar yen is above all the major moving averages. Market is still bullish dollars. And I think that it's just going to bide its time ahead of the rate decision with a positive bias. I don't think we're going to get much more beyond these highs here. I don't think we're going to get much more beyond 157, 25, 35 before the inflation report. But the technical outlook will matter a lot less this week, as all of that could change after FOMC. Dollar Swiss is also popping up a little bit, finding a bottom. We went after last week's non-farm payrolls report. I think this could actually move a bit higher. I think a dollar just have a bit of a buy on dip for a move higher in the near term. Aussie also looks like it's finding some support at the 50-day SMA. And we have Australian jobs later in the week. I think in the near term, it may find a little bit of support, which is why Euro Aussie looks really good. The dollar trades will be a little trickier. Kiwi dollar, support is Kiwi dollar is down at 60.80. Resistance is up at 61.30. I think it's going to grind before the FOMC rate decision. We'll look at the charts again after FOMC to see anything changes. Right now, there is more of a negative bias. And I think like euro dollar, like dollar yen, there's a positive bias to the US dollar. So sell Kiwi on rallies, sell euro on rallies is the best trade. And of course, I still really like dollar CAD to the long side. This is a huge candle. We could get a little bit of a pullback, but the Canadian fundamentals are probably the most negative after last week's developments. And I think I like buying dollar CAD the most on dips. Boris will share his thoughts on gold, but are there any questions for me? Let me see if there's any questions that you may have for me today. Like I said, it's a very busy week. These are the weeks that you want to be a BK member, because we live stream every single day talking about all the events, inside and after, before and after these rate decisions, and really prepare you all for the market's developments in the coming week. All right, so I don't see any new questions. I think I've answered most of your old ones. So let me pass it on to Boris. And stay everyone for live trading, because Boris will kick off with live trading shortly thereafter.
Hey guys, I'm just gonna grab the screen from Kate. Hang on just 1 second. Let me just grab the screen from her. Me show my main screen. Okay, you should be seeing my screen. Hi guys, hi everybody. How's everybody doing? Good to hear from you guys. Good to see you. We're not going to talk about silver. Silver is same story as gold, which is going down right now. We are going to talk a little bit about gold right now. Look at the gold chart. Gold had a couple of very interesting fundamental news last week that I think maybe the market is underestimating. There was news last week that China stopped buying gold. I don't know if that's true or not. I don't know if they're just basically pausing, but that's a major piece of news because they were a huge bid in the market. Russia has been also, I guess, a pretty big bid in the market. Maybe both of them decided to kind of pause their accumulation. And I think what you're seeing in gold now is the struggle. We hit that almost hit 2,500 a couple of times, and then we just collapsed all the way back down to 2,300. And I think that's a very important point. That as we test at 2,300, if we break that to the downside, it really means that gold could be in a little bit of a corrective mode here and consolidative mode after a very nice pushback. To me, I don't think we have a bullish impulse until we clear 2,500. Just like if you remember a while back when we were talking about, we don't really have a bullish impulse until we clear 2,100, which was the all-time high. Once we cleared that, there was a really strong bullish impulse for about a month and a half. I think we're in a sort of the same mode. We are in consolidation. Yeah, you may be willing to buy the dips right now. You may be willing to sell the rallies, but overall, I think gold is not a pure buy as it once was. Equities, on the other hand, are just treading water. Interesting thought about equities, by the way, that you might take under advisement. There was a study done. I posted it a while back on my Twitter of something called Turnaround Tuesdays, where if you bought the Tuesday sell-off, Monday tends to be a little bit of a sell-off anyways, and we might be looking at a sell-off right now. But Tuesday tends to have like sort of an early morning sell-off and an afternoon rebound. That has been like a massive outperformer against the S&P for the last 20 years. So keep in mind if we get a rally in the afternoon tomorrow, the Turnaround Tuesday could be a really interesting trade. Other than that, it's all data, as Kathy was talking about. So all eyes are going to be very much on all the data. If you are interested in trading this week, and if you're interested in taking advantage of all the volatility, we're obviously going to, we have like the last few days of the Apex discount, 90% discount. I highly recommend you guys, Kathy just posted the link in there. I highly recommend you guys take advantage of it, because if you can lock in all those really cheap Apex evaluation tests, you'll be able to trade the volatility this whole week. You might even be able to pass the test in like one single day if you're on the right side of the flow. Also, if you want to join me, I'll post my pass the prop link, which allows you to basically get coaching with me and show you how we pass our prop tests and trade our money. But the really cool news and the really strong news of why you should all come join me in the room is over the weekend, I rewrote all of the indicators, which are completely not available. You're looking at the chart over here, the super simple scalpel indicator. You're not going to find it anywhere on TradingView. It's strictly for our BK members only. And I rewrote all of this in PineScript 5.0, which is the latest version of PineScript. It's object oriented. It's much more robust. Everything is working super fast. So you can actually see this is the simple scalper. And let me put the super scalper on. And you can see the super scalper now. If you wanted to just kind of play around with all the goods, you can put the stops on there. You can show the table on here really fast. Gives you full analytics. You can take it off really fast. All of that really cool part of 5.0. And I recommend you guys come join me, because this is all a completely free upgrade that I'm going to be sharing with everybody in the room. Otherwise, I'm going to see you guys in 15 minutes. So be sure. Yeah, so Kathy just put a big discount to the membership there. And actually, hang tight a second. Let me see if I want to put the I'm going to put the discount in the room for my coaching, because tomorrow night is my coaching night. So if you want to join, you get a chance to pretty much, let me just find the link. I'll get it to you. I'm putting it inside the room right now for you guys. This is a great deal. If you want to come join coaching with me, you basically get 3 months of Kathy and me for the price of like 1.5 months, plus the coaching. So take advantage of that if you like. Come trade with me. We're gonna have a really, really good time. I have a whole new setup in addition to the setup that we've been trading that's gonna double your opportunities on a daily basis. I love, I'm gonna share with you, and it's all really part of this whole 5.0 rewrite. It makes it a lot easier to catch all those trades. So I'll see you guys in the room in exactly 10 minutes. Everybody else, have a wonderful time. If you want to come join me for free live trading, don't forget tomorrow free live trading on YouTube again, and Wednesday free live trading on YouTube again. So we're going to do that same thing again, and I'll show you everything that I'm doing. I'll see you guys all. Everybody have a wonderful day. Everybody take care.